Hello, good afternoon, and welcome to this live Wealth of Advice market update on the 18th of August 2023. We are a couple of minutes late start there. We're just waiting for a few more people to join. Pleased to confirm that today we've got a guest speaker coming on shortly. That's Ritu Vohora. She works for Rowe Price. She's an investment specialist there. So she'll be coming in a couple of moments to answer a couple of questions we put to her. The overall agenda for today, as I said, have our guest speaker on. Then we'll go through like what market update will look like when you watch them normally when we record them and send them out. Obviously go through what happened in markets in July, and then obviously we're into August now, which hasn't been such a great couple of weeks in August so far. Discuss that. Obviously look at what's happening in the UK with interest rates, inflation, GDP, house prices, lots of things being in the news. Across in America, their inflation figures are looking much better than ours. How that affects things. There was a US credit rating downgrade a couple of weeks ago, which spooked the markets for a day, but nothing really then happened thereafter. And I don't think we should be too worried, because I don't think the US is going to default on anything anytime soon. And then we'll close off, as we normally do, with a performance analysis of how various stock indices and markets around the world are doing. So without further ado, we will now invite Ritu to come on. Ritu, as I say, is an investment specialist at Rowe Price. Thanks very much, Ritu, for coming on today. Obviously, I know you've got a busy schedule and such like, so very appreciative of you coming on today. We did send across a couple of questions last week, so I'll just kick off and ask the first one. And that was to ask for an update on how US and global equities have been doing, what's happened so far in 2023. And do you and Rowe Price think that we're over the worst of what we saw, those horrific falls in 2022?
Great, thank you. And thanks so much for having me today. It's great to join you. And I think the challenge is going to be summarizing what's happened in a very volatile year in just 10 minutes. But I think if we think about it more broadly, 2022 was really the year of inflation. And it really forced global central banks to hike at the fastest pace that we've seen in a decade. Now, we are moving to a new regime, one of higher inflation, one of higher rates, and one where we've got all that liquidity that we've had over the last 10 years being pulled out of the system. So we felt the first cracks last year with, the pension crisis here in the UK, around the LDI, and that was really around assets and liabilities being mismatched. But it was really then that the market started worrying about whether we'd see a recession in 2023. And I think, as we started 2023, it actually started on a much more optimistic note. We had a much milder winter here in Europe, which was good, particularly for energy markets. But we also had China reopening, which saw markets initially see a significant rally. But also a lot of those supply chain issues that we had in 2022 are getting better. And so that, again, has been positive for markets. But we've seen a shifting narrative. So we started the first quarter pretty optimistic. And if you cast your minds back to March, that's when we had issues around SVB, which is Silicon Valley Bank. And again, that was caused very much by, high interest rates and also that liquidity being pulled out the system. Now, high interest rates don't impact the economy on day one. It often takes 12 to 18 months. So we're still going through that process. And really, when we look at the economy, I don't think it's still felt the full impacts. But of course, Silicon Valley Bank was maybe not a black swan event, but maybe a black duck, if I can call it that, right? So it was in the end of the markets, and we haven't seen contagion since. And so to your point, I think, markets have been much more optimistic this year, less because things are as good, but I think more because a lot of the fears that we thought at the beginning of the year haven't come to fruition. So if I just outline a few of those, one is the US economy has been much more resilient than many of us thought. When we look at the consumer, they're still spending, particularly on things like services. We're all going out to hotels and traveling again. So that, again, has really kept the market afloat this year. And even when we look more broadly across areas like emerging markets, they've been much more resilient than maybe we thought at the beginning of this year. Now, clearly, closer to home, both the UK and the Eurozone have much more of an inflation issue, so growth is likely to slow. But overall, the economy is not as bad as we thought. And the other big sort of positives we've seen in markets is inflation is clearly still a risk, but it is coming down. And you mentioned there across all regions, we have seen it coming down, particularly moving from goods to services inflation. So that is definitely coming down. Now, I would caution, though, that, what we're watching now is wages, and wages tends to be quite sticky. And I'm sure you'll talk about in your updates later, but that is something that I think the central banks will want to see wages coming down to meaningfully see inflation coming down from here. But I think the positive for markets is that we have probably reached peak rates. So we do expect rates to be higher for longer, but hopefully not too much higher from here, particularly in the US. And the other point I'd make is when we look at companies, they've been in a much better position than maybe we thought at the start of the year. Companies have been passing costs to consumers. I don't know about you, but I've been out to restaurants and I'm happy to pay the extra prices because we haven't been out for so long. And I think consumers have much healthier balance sheets. So again, that's meant corporates are much healthier. So to your point, I think we're in a better position than maybe we thought, but there are still some risks ahead.
And the next question, obviously from a technical point of view, a bull market is when markets have gone up by a certain percentage over a period of time. We were technically getting into that territory where you could have said the US market was on a bull run. For most clients watching this, it doesn't feel like we're on a bull run because they won't be invested 100% into one stock market. They'll have a multi-asset approach across loads of different indices and different asset classes. But in general, do you think when we look at the stock market, because some clients watching this are considering or have just recently maybe altered their asset allocation to move from, say, 40% in the stock market to a portfolio of 50% or 60%, generally speaking, do you think that there should be optimism with what we look at for equities going forward over the 2, 3, 5 year view? And as I say, those sudden, some equity funds in 2022 were down 25-30%. I mean, do we expect to see any falls like that in the coming period? Obviously, we're not going to hold you this. No, you don't have a crystal ball, but I certainly feel that we're over the worst of what 2022 give us, and equities will be the place to give us the growth after this inflation bomb. Would you tend to agree with that?
Yeah, absolutely. And I think you're right. Look, 2022 was a very painful year. It's very rare that you get stocks and bonds falling together double digits. And I think if we go back to the 1920s, it's only happened 3 times before. So hopefully it's an outlier that's not going to happen again. But to your point, I think when we look at what's driven the market this year, it's really been a handful of stocks. So, of those magnificent 7, and that's companies like Meta, Facebook, Nvidia, Apple, Google, and Tesla. They've driven the bulk of the rally in the US market. So just those 7 stocks have accounted for almost half of the returns in the US market. And just to give you some context, those 7 stocks now account for 30% of the S&P 500. So it's a very, very concentrated index. And, the last time we've seen that much concentration, you have to go back to the 1960s. So, the worry here is, can these companies continue to deliver? And I think a lot of the positive sentiment we've seen in market is kind of the golden duck, maybe not the black duck, but I think AI is a game changer. It will change our lives. This is not just a hype. It will change our lives. It will change the investment landscape and the productivity of companies. Now, clearly what we've seen this year is companies like Nvidia have had blowout earnings and they will continue to do well. I think we're still early in that cycle. But I think what's important from here now is really to pick between the winners and the losers, because even though we're still early on this AI hype cycle, not everyone's going to be a winner. And when we compare it to similar to what we saw in the 2000s, companies today are in a better position they were back then. They have good fundamentals, they've got strong balance sheets and good cash flows. But now what killed the tech bubble in the 2000s wasn't that things got very expensive. It was that companies starting to miss on those expectations. So you can have a market that's expensive that continues to do really well. So to your point now, something we're looking at is, can these companies really continue to deliver on those expectations? And what I would say is, a lot of these large cap companies are very good quality. Companies like Microsoft, we all use the cloud. I'm using Microsoft Teams right now. They will benefit from AI that will make things much more productive. They've also got the cloud. Companies like Amazon as well have a lot of data. So these companies can continue to be winners. But I think what's going to be important from here and over the next 3 years is really differentiating who are going to be the winners, who are going to be the losers. And really, I think it's not about chasing momentum or just picking the winners. It's going to be about avoiding the losers. So risk management, I think, is going to become much more important. So when we look at the US market today, I think, in aggregate, it looks expensive. But now, because it's been such a concentrated rally, you've got the other 493 stocks that have been left behind. So there's a huge opportunity now. And we're finding ideas in areas like healthcare, financials. But I'd also say investors should look abroad, areas like Japan and emerging markets, much more attractive valuations. And that's actually where we're finding opportunities that I think will set investors up good for the next few years as well.
I'm glad you've said those few bits towards the end there, because when we updated our asset allocation models at the end of July, Japan went in there. We moved some from the US large caps into the US smaller companies, hoping that, like as you say, that concentration of growth has been good in the first half of the year. But the next stage of this, after we get over these huge inflation shocks and such like, it will be the smaller companies to come out. And what I mean, again, for any client watching this, when you look back over history, the smaller companies will fall the most when markets collapse, but when they bounce back out, they pretend to bounce back very quick, in a much quicker fashion. So that's kind of what we're hoping for, albeit, as I say, at the moment, there's been a little bit of volatility in the last couple of weeks. So hopefully that calms down. As I say, by the time I see you next week, which will be at the Rowe Price conference, the back end of September, hopefully markets have calmed down a bit from now, and I'm hearing positive things at that conference in September. It is a conference I go to I think I've been the last 3 or 4 times it's been on in London. And as I say, we always report back to clients what we hear from there. So brilliant. Thank you for joining us today.
Yeah, and just one thing I'd say, just on that point around volatility, I think people always think volatility is risk. Volatility is not risk. Volatility can often be opportunity to buy into areas that are unloved. So to your point, I think, US small caps are looking interesting. Japan, they've been priced for a recession that just hasn't come to fruition. So to your point, I think, sometimes volatility actually creates opportunity. But the important point here is, stay active and take that long-term view to deliver those returns.
I totally agree. Brilliant. Thank you. Well, thanks.
Great. Thanks so much for having me.
And
Thank you.
I'll see you in a few weeks. Cheers. Bye now. Again, if anyone has any questions on the back of that, please fire them through. As I say, we didn't give Ritu any sort of script or anything like that, but it was pleasing that to hear comments and such like, which backs up kind of research that we've been doing ourselves over the last few weeks. When we look at the model portfolios that Wealth of Advice have, we've made change to that. Also, if you look at sort of the Royal London asset allocation, Prudential, Legal and General multi-index funds, they're all making similar moves as we've gone through the year. And this hard recession has 100% been avoided in the US, which has been absolutely fantastic. If the US had a hard recession, then you would have seen bigger falls in 2023, but it hasn't happened. 2023 has been a positive year overall for markets, but as I say, in the last couple of weeks, we've given a little bit of that growth back. And as I say, during the month of July, the rally that we saw started June continued. It was all brought about because of the fact that the US data was suggesting that inflation had come down, and this soft landing where you can bring inflation down, maybe slow growth a little bit without causing a recession, was looking more and more likely. Employment was is weakening, which is a good thing for inflation. It means there still is enough jobs out there. If people lose their job, they can find another one. But instead of having, say, 2 jobs available for every one person looking, that figure would come down maybe to 1.6 jobs for every person looking. And businesses are still looking to employ. In the UK, we have perhaps the big problem with our inflation, because it's remaining persistently high. It depends how you look at it. When we saw the BBC website on Wednesday, I think it had a positive headline for a change saying inflation comes down for the 2nd consecutive month. So I was looking at that, say 12 noon in the office, 8 a.m. when I put Bloomberg on to see what the inflation numbers were. All the analysts on there were saying we were hoping it was going to be 6.7% or lower. The worrying part of this inflation number in the UK is that core inflation, which excludes volatility, market and food prices, stayed a bit higher at 6.9%. So when we look at the graph that you should see on your screen right now, and we see where inflation got to well above 10% there a few months ago, it is nice to see that it's coming down. However, Rishi Sunak and his friends in the Conservative Party want this figure to come down below 4% as they go into a general election year next year. They want to get this figure down, and they had hoped that it was going to be down sooner than this. The problem that they've got and we've mentioned UK wages remaining sticky there, is the fact that people who are on strike, who get a pay rise, and a lot of them have been getting these pay rises, will go out into the wider market and spend this money that they're earning extra. So wage price growth in the UK has remained strong. As I say, that's very, very inflationary. So on the back of the high inflation numbers, we look at UK interest rates, which for a lot of people watching this, you might have friends, family, children, etc., who have mortgages and such like, and you hear a lot of people saying that mortgage rates and mortgage costs are going up. The next graph that we're showing on the screen now, you can see what interest rates look like going back to the 70s. It's very easy just to only have a memory going back to 2008 and think the normal interest rate was down to zero there. It went almost negative last year, if you remember. We're now back up to 5% interest rates. And if you look at where they've been, and again, some of the clients I speak with who are coming to retire or retire now say, well, I remember getting my first mortgage when they were 15% or 12%. That was unusual as well. That was a really high peak. We had inflation problems in the 1970s, which is why interest rates went up to try and combat inflation. We then managed to get it down, as at the end of sort of Mrs. Thatcher's time as the Conservative Party Prime Minister up till 1990. She believed that she'd strangled inflation, it had come down, and then we had, as I say, a 30-year period of low inflation, but with that was low interest rates. So the 5% interest rate that we see now, or the 5.25% as we are now, which was raised on the 3rd of August, there was hope that that might be the end of the interest rate hikes. However, some pessimistic analysts that we read information on are now thinking interest rates could go to 6% in the UK. It's really going to be important what the Bank of England does in the coming weeks and months on the back of this, because as Ritu said, when you raise interest rates, it often takes a full 12 months for the effect of that interest rate rise to actually affect the economy. The Bank of England have said they won't ever think about cutting interest rates again until inflation gets closer to that 2% target. The Bank of England are going to meet again, I think it's at the end of September. And as I say, there was a kind of split within the committee members as to how much they should raise it at the last time round. So now we're wondering, are they going to go from 5.25% to 5.5%, or maybe to 5.75%? But as I say, we'll certainly keep an eye on that. It has had a positive impact in certain parts of people's lives. Bank savings rates have gone up. So you're seeing some good rates offered by various banks and building societies for people sitting on cash deposits, which wasn't the case 3-5 years ago, where you were getting nothing for your savings. Now you're getting some good rates there. And also clients who are considering retiring or are retiring, have a retirement fund, are wondering should they perhaps purchase an annuity, something that we never really spoke about much over the last 10-15 years, because annuity rates are linked intrinsically to interest rates. So they were really, really low. Well, they've effectively doubled annuity rates in the last 12 months, and more people are talking about those. So like anything in life, there's definitely disadvantages to interest rates going up. It's negative for borrowers who have high mortgages and such like. It's negative for businesses and companies who have large borrowings, but it can be positive for savers and those people at retirement who might want to buy an annuity. So it's all about how it affects each individual. UK GDP, gross domestic product, is a measure of how much we're spending in the economy. If you have two negative quarters of GDP, we had a negative quarter in Q3 2022, and the whole world, the IMF was predicting that the UK would go into a recession at that point, because the next quarter would have been negative. We then had 3 positive quarters. We'll wait to see what that figure is out for Q3 2023, obviously, and see where we're going with that. It may be that those interest rate rises have had the required effect by then, and Q3 is negative. Now, you might say we don't want a negative quarter, but we probably do, because we want to see those prices stop going up. And again, as Ritu explained, not just in the US, but in the UK, the consumer has remained very resilient. So whilst you may hear stories of people on low incomes, low budgets being really, really tight right now, for a lot of people in our country, the ability to go out to a restaurant, to a hotel, to book a holiday, yes, it may be that little bit more expensive, but for the vast majority of people, they're still being out spending. Again, if you look across to Germany, where they've had a recession this year, German consumer have a bit more of a cautious mindset. The UK consumer, Germans were expecting last winter to be really bad and what was going on with the Ukraine war, that they were going to have an energy crisis. So the Germans stopped spending money quite across the board, really, and that brought down their gross GDP, obviously caused a mini recession. But their inflation figures are now looking better than ours because we're still outspending. Those inflation figures are higher. When we look at the UK and our economic growth forecasts, I don't know if anyone read this earlier on the week, but the National Institute of Economic and Social Research, their forecast is that the UK is going to see a real slowdown, if you like, over the next 5 years, a stagnant growth through to 2025 at least, but the next 5 years just isn't looking good. And they commented that inflation, political churn, global economy slowdown, oil shocks, strikes, and there's a lot that resonates with the 1970s. And as I say, we've read this several times. We've mentioned it here a lot, that this is a depressing backdrop for the UK as we go into a general election year. And there is this fear that there's going to be no major growth in the next 5 years. But if we think back to the graph we showed there about how the real GDP worked, you hear a lot of these negative predictions and forecasts, and yet the economy still grows over certain periods of time. So it's something we'll keep an eye on. But that said, my fear in the next 12, 18 months is that there's no real policies coming through from government which is trying to stimulate growth in the economy, or it doesn't feel that that's the case. And certainly when you look at UK investments and how much is held in the UK for most main investment funds, the amount invested in the UK has been reducing for most managed funds over the last 12 months or so, because nobody is really confident that the UK markets are going to do well. When we come onto the performance of how UK stock markets have done compared to other parts of the world, that little nice bull run that the FTSE 100 had, where it was outperforming other indexes when the oil stocks were really boosting them. If you look at that over the longer term, we lag way behind on performance. So that's not good. This chart that we show on the screen right now looks at overall growth in the GDP of most of the major countries around the world. This is the G7 countries, and you can see there that the UK is the only country of the G7 who is not yet above pre-pandemic levels for where the economy is. We're almost slightly there. We're just below that blue dotted line. But you can see the US is about 6-7% higher than what it was pre-pandemic. Canada's way up. France, Italy, Japan and Germany all doing well. And the UK is the one that's languishing behind. Some people might point to Brexit, point to the pandemic, point to what's going on politically. But overall, the UK has been behind. So these negative predictions of what the next 5 years growth may be, it is borne out by what the data's shown us, unfortunately. But as I said, to compensate for that, we have moved the portfolio so that they do invest more in a global fashion than perhaps they would have done in the past. A big area that people in the UK will look at is how they view their overall wealth, is how UK house prices are doing. Again, you might have seen some stories in the last few weeks which seem to be really negative. One headline read that it was the biggest fall in house prices since 2009. It would have been great if you could have put an extra few words after that sentence, which ended it saying, but nowhere near as bad as the fall saw between 2007 and 2009. So again, it's all about how you package a story up. And when you look at the actual falls over the last 12 months, the Halifax index, which was always the one that most news companies refer to, because the Halifax is one of the biggest lenders for mortgages in the UK. Their index was down 2.6%, but on this particular day when I read this story, it was the nationwide story that was focused on. The cynical person might say, well, why is that? Well, the nationwide one showed a minus 3.8% fall over that same period. Either way, it's negative over 12 months, but it's nothing like a 10, 15, 20% fall. For the clients of ours watching this today, I'm guessing we don't have anyone watching from the southeast of England. It's always regarded and expected that if you do have big house price falls in the UK because mortgage rates have gone up, that it will be the southeast that's affected more, simply because they've got so many more houses that are priced a little higher than what you get in the northeast. And if we can go through this current housing price downturn in the northeast, we're seeing falls of 3, 4, 5%. It's not going to be the end of the world, because if you look back in previous years, that can be made back quite quickly. Lenders have started to cut interest rates again, which is positive. That's showing you that the expectation is that we've reached almost peak interest rates, as Ritu was saying. And when you look at the longer term expectation of rates, it means that rates should or could fall in the future. US CPI, which is their core inflation, rose 3.2% in July. That was in line with expectations. The Federal Reserve, however, just to keep everyone in check, said this doesn't spell out a victory, but it's looking more and more likely that they will now sort of pause their interest rate rises. So if the US have reached their interest rate peak, I say for everyone watching this, the majority of the portfolios now across every investment provider we use, you have a bigger bias to the US. So if the US have peaked their interest rate rises, that is a very, very positive thing. And hopefully we're getting close to when rates may be cut slightly in the future and we start getting those big jumps in the markets overall. So that's definitely a positive when you hear that US inflation is now 3%. If we look at how it's actually going, if you like, with regard where their inflation comes from, over the last 12 months, 3.2% is a headline figure. All items less food and energy, that's still 4.7%, but it's a hell of a lot lower than the peak where it was when it got to almost 9% at the end of 2022 there. So definite positive things there. And like everything we've had this year, you hear one positive story, you then get a negative story. US credit was downgraded from AAA to AA by a rating agency called Fitch. These rating agencies just look to see, anyone has an Experian or an Equifax account themselves will see on a monthly basis, every individual's credit score goes up and down on a monthly basis, depending on how you're paying your bills and such like. Well, it's no different from a government. The US has got trillions and trillions of debt outstanding. And because they've recently raised their debt ceiling and they're still taking on more borrowing, Fitch decided it'd be a good idea to downgrade them from a AAA, which is regarded as the most reliable of debt, to AA. We should not be worried about this unless the US ever went below single A, which we don't think that's ever going to happen. US government bonds are still the safest debt for anyone to hold. The dollar is the world's reserve currency. And all companies around the world who deal globally need dollars to transact. So yes, it was a news story that day. Yes, markets fell by 1.5% that day, but it hasn't really affected anything in the long run. So we're now getting close to that final part of the portfolio, of the market update, where we look at what the market performance has been. The first graph that we're kicking off with today shows how different stock markets have performed since June the 1st. As I say, I opened my silly mouth at the end of July on the market update we did then to say we'd had 2 positive months. Things were starting to feel somewhat better. And as you can see, as we got into August, things have come down a bit from there. But overall, apart from the FTSE 100, as you can see at the bottom there, minus 0.95%. The S&P and the MSCI World Index are both positive over the last couple of months. So we shouldn't be too negative. The fact that markets have gone down the last couple of weeks, it has been positive, as I say, since the beginning of June. And hopefully that continues. When we look at performance in 2023, again, as Ritu was saying, those big technology companies in America have dominated, have grown so much. The NASDAQ, which is the line at the top, which is purely the top 100 technology companies in America. So everything being fueled by this artificial intelligence investment, that's shot up. So if you'd been investing in the NASDAQ alone this year, it's up 28.96%. Asia is at the bottom there. The hope that after China had reopened and we were going to see obviously the end of their lockdowns happen and we were going to see China come out and everyone would be booming again with China exporting cheap goods and supply chains open up. It is happening, but maybe not just as quick as what markets had expected. So Asia ex-Japan is minus 2.3, emerging markets minus 1.91, FTSE 100 1.54. So as I say, outside of that big number at the top, the 28 for the NASDAQ, you're seeing smaller numbers there. And again, all of our clients have a multi-asset, multi-index approach. So we all have a little bit of all of these in there, but most portfolios, as I say, are more weighted towards the US. When we pull that graph over 12 months. S&P going back to August 2022 is still minus 1.81. So although it's grew decent since January, over a 12-month period, it's still negative. FTSE's up 1.51 over that same period. Remember in February when the FTSE reached all-time highs, how quick that came away. It jumped again a little bit, but again, FTSE's down 500 points in the last 2 or 3 weeks alone. So still got that volatility out there, albeit it is lower than long-term averages. And as Rita says, hopefully fund managers who we use can find some positives and some opportunities to invest into. And this is again the graph that we ask all clients to focus on. Look at how things go over 5 years. Yes, it would have been great to have a crystal ball and go back different periods and change the asset allocation and go in the one that's performed the best. But overall, now we're happy with the allocation we've got and where Royal London and Prudential and Legal & General have theirs as well. Bond markets, you'll have heard me a few times say that bond markets have been underperforming and will continue to do so when interest rates are rising. This kind of confirms that. So you're not getting any real sort of positive returns in the recent past from most bond sectors. High yield bonds is the best performing sector. High yield bonds are the riskier end of the bond market, often act like stock markets do so. But when you look at the more normal bonds, if you like, from the sterling strategic bond down, very poor or negative returns since the beginning of 2023, and all of them are negative over the last 12 months. So you haven't had anything from the low risk part of the portfolios really. This now looks at it over 5 years. And as I say, for UK index linked gilts to be down 25% over 5 years, that just shows you the effect of what Kwasi Kwarteng did in his budget last year, and the fact that they were too overpriced going into that and they dropped the most. So the low risk asset classes did a lot of damage in 2022. Alternatives, cash, if you had money in cash since the beginning of the year, it's up effectively 2.69%. Properties just about broke even, 0.67%, but then gold, global infrastructure, commodities, all of them very negative since the start of 2023. And again, when we look at them over 12 months, some double-digit negative returns for those alternatives as well. So very difficult period, as we say, over the short term. Look at the long term, gold up 52%, Bloomberg commodities up 35%. So the long term, as we keep saying on these updates, is what you have to look at. The short term felt like it was getting better again as we got to the end of July after a couple of good months, a couple of negative weeks in August. But overall, I am positive as to what the next period is. I think the worst of 2022, as Ritu said, is well behind us. And it's what companies do next and how companies absorb the fact that certain product areas, certain services have held well through this period of high inflation, high expenses. People are getting wage growth. People are spending that. How will that affect? Although you might hear some people losing their jobs. I know Caterpillar, I think, laid off a few of their temps recently. You would expect that those people are going to walk out and find another job somewhere else quite quickly. It's nothing like the 1980s or the 1970s where people are losing their job and stood at the back of a dole queue waiting to get in the dole office, so to speak. You don't see those signs on the TV. So yes, it's not the best of economic conditions. It's definitely not the worst. And as I say, I think last year's terrible year is well and truly behind us. So we look forward to the future. And at that point, I'll ask if anyone has any questions for us.
Almost short-term versus long-term investing. And I think you mentioned it a couple of times today on that focus for the long-term, which I think probably goes hand in hand with how often should someone check their valuation. It's quite a common question that people have been saying to me in recent review meetings.
I mean, on the point of how often you should check a valuation, we brought clients an app. The Financial Conduct Authority was kind of part of the reason for that. We have consumer duty now where we have to provide accurate, up-to-date, not misleading information to clients in a very simple fashion. And we believe the app delivers that. I know people might have had slight issues with passwords and other things getting reset, but for the vast majority of people, the app works very well. Should you be in there every morning checking the valuation? The answer is no, you shouldn't. But I mean, I check my own pension value every week or so, every couple of weeks. I mean, it's a natural thing that you're going to want to have a look at what your wealth is. For the short-term and long-term investing, again, someone comes to us age 55 or 60 or 65 to retire. We know that that retirement time horizon is going to be 25, 30 years where they're going to be drawing money out of these pensions over that period of time. And the long term is the 3 to 5 year view, and we keep saying that to people. The unfortunate thing is the current 3 to 5 year cycle that we're going through at the moment includes the 2020 COVID year. It includes November 2021 to the back end of 2022, which was, as Ritu said there, was as bad as stuff that was happening in the 1920s. So it is difficult to say, just look at the long term, don't worry about the short term, because if you're checking your valuations and your monetary value is going down, it's obviously going to be a worry. However, if you lift the bonnet up and look at the individual companies where we've got clients invested into, they are good, solid companies that aren't going bust anytime soon. Wilkinson's was obviously in the press last week. They've gone bust. I can guarantee you Wilkinson's was not in any of the funds that we've recommended. You know what I mean? Nobody would have held that company, because for a number of years, it would have stood out like a sore thumb that Wilkinson's was in financial difficulty. That said, I put my hand up and say Wilkinson's was a private company, wasn't it? But the point being, you hear these big companies going bust. They're very rarely in the investment funds that we use, because, as I say, the fundamentals of some of these companies just stand out like a sore thumb as to when that's going to happen. If a company's doing bad, it's kicked off the FTSE 100 or kicked off the FTSE 250 anyway. But we're not seeing these companies go bust. We're seeing these companies actually make more profit. And that's been the big thing with the inflation story that we've had is, yes, companies have put their prices up and the fees up for certain things. But by and large, the UK consumer has gone out and continued spending, and the US consumer and the European consumer. When we were at the Riverside Cricket Club in January, there were certain stocks asked about. Netflix was mentioned by one fund manager because their share price was down 60% last year, and there was a big fear that they were going to maybe disappear or such like. They were going to change their subscription package so that you couldn't have one person paying the membership fee and 4 of the family members just joining on the back of it. Everyone would have to have their own membership. Well, that's happened now, and guess what? 2 out of 4, the 4 family members have been booted off, have actually then getting a subscription themselves, and Netflix share price is shooting back up. Ritu explained that it's the big companies that have seen such big growth in their share prices. Again, anyone watching this who is a former Caterpillar employee might look at the Caterpillar share price, which I think got to over $290 a share for one particular day this year. Some big growth has been seen on some of these big stocks, and what we need next is the smaller ones to come up. So yes, we're talking about short-term numbers and such like, but the long-term has to be that we get over this current downturn and markets are positive and clients' fund performances come back.
And just one other question that we've got from just sort of recent meetings, and that tends to be about the level of equity risk needed in portfolios, specifically for people who are in drawdown, taking a regular amount of income from pension.
Yeah, I don't know if anyone watching this has heard me say this. Sometimes sound like I'm repeating certain statements, but it's true and it stands up very well. You go back to 2003. Clients who were retiring then, taking drawdown product out at that point, were being sold a balanced managed fund that might have had 75% in the stock market. You fast forward to 2008, we had the financial crash then, interest rates went to zero. You come out the other side in 2009, 2010. We then had a decade of low risk government bonds, corporate bonds, producing really good returns over that period. So you started seeing, and with pressure from the regulator, the FCA, saying you shouldn't have too much invested in the stock market because the markets fell in 2008, 2009. That most asset allocators reduced the amount that was in stock market funds because you were getting returns from all different sources. And now we just look at and think, well, equity markets did bad in 2022, but your low risk assets did as bad as them. And when you look for a bounce back, there's a saying that bonds don't bounce. Yes, they'll recover, but albeit at a slow basis. As we've seen on there, the graphs that we've had on the screen, bond performance has been flat this year. If you want to see some growth, and you were taking a regular withdrawal from your plan, then you have to go into equities, and equities will provide that long that longer, better returns going forward. And for those people who say, well, I'm too cautious, I don't like that. Well, as I say, let's have a look at what 2022 gave you. There was nothing cautious about the returns from some of those low-risk asset classes in 2022. So I think it makes sense to have a pragmatic approach and say, this is the conditions we find ourselves in now. Interest rates are here, inflation's there, this is the withdrawals I'm taking, let's adjust the portfolio. And it doesn't have to be a permanent thing. You can go high into a mod spec or balanced portfolio and then maybe bring it down as you get older and you spend less in the future.
And as Ritu said, volatility doesn't necessarily mean high risk. It can be opportunity as well, which I think is also the point of the chance for the return and chance of providing that sustainable withdrawal rate in retirement.
100%. And the inclusion of Japanese stocks, as you mentioned, and other markets that might not have been so favourable a year or two ago, it's felt that there are opportunities there. As I say, whether you have the wealth of advice models, where we now have the discretionary permissions to change those much quicker than what we've done in the past, or the Royal London or the Legal and General portfolios, you're seeing a lot more movement across asset allocations and sectors from these fund managers to take advantage of these opportunities. And again, if you go back to 2022 and you look at the percentage that fund managers are sitting on cash, waiting for opportunities to invest in certain areas, now they're not holding on to as much cash. They're finding out these opportunities and they're getting invested. Yeah, well, thanks again for listening to the Wealth of Advice Market Update. First or second thing we've done live like this in the last 12, 18 months. I know we got a decent number of people to join it today. We have recorded this. I hope it's bloody recorded, and it's going to get sent out to clients who haven't been able to watch. But like I say, anyone watching who has any questions, queries, please don't hesitate to get in touch. And as I say, we'll be on hand to answer those.